I want to talk about VAT, value added tax, for any brand out there that is selling internationally currently or thinking about it to understand this concept and how it impacts cash flow specifically. So, the value added tax, this is just a way for the government to collect tax from its citizens, and businesses basically act as the middlemen to give this money over to the government at the time of sale or at the time of import. And there's a couple things you can do with cash flow. But to start with an example of how a company might do this the standard way, they have units in a container and a value of that container by multiplying the FOB and the unit cost. Let's say they're importing it into the port of Hamburg, who has a 19% VAT rate. On the date of import, this company is going to owe 47,500 euros. Let's say during that month they sell 1,250 units. When they have their monthly filing on May 31st, they'll have 10 days to make a payment. And so the way the VAT owed is calculated is, number one, this company had 1,250 sales, an average VAT of 22% since they're selling to countries outside of just Germany. So there's you basically have to, each country is going to have a different VAT rate, and then the average price of 250. So you'll notice that this is going to calculate the VAT collected from customers, 21,250, and then you can get a refund on this 47,500. Some companies don't even remember or have enough organization to the point where they can collect this 47,500. Oftentimes it can get forgotten. And then let's say they sell the rest of their units in June. Similar deal here. Payment is due 10 days later than the last day of June. So what this cash flow looks like is you're giving up $47,500 on May 1st, another 21,000 on June 10th, and then another 157,000 on July 10th. Now I want to show a second and third strategy here. So the next one is called deferment. What this is basically at the time of import, you don't actually pay the VAT owed. So instead of the payment being due on May 1st for this import, it's due at the time of filing. And when you do this, now you owe no money up front. You do pay that money 1 month later. So that's why this number in F17 is higher than C17. And you have the same payment for the month of June. So if you consistently did this across all your containers for all your sales, it's going to add up over time of being able to delay this. And imagine a scenario where this company imported a container, but they didn't sell anything from that container. This would get deferred even longer. So they wouldn't have to pay that container value. So this is a strategy that can delay cash flow a bit. Then the second thing you can do is apply for a 1 month extension. So what you'll notice here, I've highlighted, instead of having to make the May payment on June 10th, you can make the payment on July 10th. And then for July 10th, you can make the payment now on August 10th. And if you do this, like I said, across all your containers, it's going to add up very quickly.